Mortgage rates are more sensitive to good news than bad news right now, which means it's going to take much weaker economic data to actually move rates lower. But even slightly good news sends them much higher. With Fannie Mae now expecting rates to gradually fall into the low sixes, the question is, should you wait or actually make a move now?
That's the $24 million question, right,
Always,
Jeb? Always, yeah. So what we're going to take a little different view at it today. Generally, when people ask this question on the live show, they say, what's happening with rates? What's going to happen next? Should I lock? Should I float? We have a ton of uncertainty that is not going anywhere in the near term. So when we say near term, 30 days, 60 days, 90 days, I don't believe that uncertainty is going away. So if the underlying data should lead us to lower rates, probably not going to happen because of that uncertainty. If the underlying data should lead us to higher rates, also probably not going to happen due to the uncertainty. But in times of uncertainty, you're more likely to see a negative move, rates higher than rates better. So what we really wanted to take a look back is, what is it that Fannie Mae's economists are looking at and seeing right now that leads them to believe that rates are going to be a little bit lower in the future? And then we'll also look at the flip side of it. What if they're wrong? What could lead rates higher? Because for most of you watching this, we talk about this all the time, and for whatever reason, it triggers a small element of the viewing audience. The one thing that impacts affordability that can move significantly in the short term is interest rates. So if you are in the market for potentially buying a home, buying your first home, buying your next home, moving, refinancing, that is the $24 million question. So while we may be frozen for the next 30, 60, 90 days, there's reason to believe that rates could get better. And there's also the possibility that rates could get worse.
Well, the one thing we've talked about many times, Josh, is the market likes transparency, right? So when the Fed comes out and kind of lays a forecast as to what to expect, the market likes that, right? Because there's something to look forward to. The problem at the moment is the market doesn't know what to expect, right? We had Liberation Day, April 2nd. Since then, we've had changes, right? We saw a major move after quote unquote Liberation Day. And then some changes since then, and even changes today with, some of the used car stuff, some of the automobile stuff with tariffs and just different things. And so all of these things, unfortunately, are going to have an impact on inflation at some point. Now, is it going to be what the market is expecting, which is higher inflation, or is the market going to absorb some of it because of some of the other factors like rent shelter data coming down, like we've discussed for the last couple of years? It's starting to normalize. So that offset could offset some of the inflation, but the reality is the market doesn't know. So let's actually take a minute here and actually talk about some of the volatility in the market at the moment. We'll talk about Fannie Mae's forecast, what's happening in housing, and how you as a buyer can move forward.
100%. And when the tariffs were announced on April 2nd, we were somewhere between 4.15 and 4.2 on the 10-year. Within 3-4 days, we saw this knee-jerk reaction all the way down to 3.85. And you've talked about this before. That never even showed up. That ultra-low 10-year treasury never really even showed up in interest rates because it was overnight, early pre-market trading. By the time rates came out in the middle of the day, we were back up somewhere near 4%. But big picture, it made rates get better by about 0.25%. Then we saw this massive sell-off in stocks, big negative reaction to this amount of uncertainty. And at its worst level, we went all the way up to almost 460. So from a bottom of 385 on the 10-year to a top of 460 within 1, 2, 3, 4, 5, 6 days.
And what are we talking about in rate there, Josh? Like, what is that change in rate?
So if we're looking, that's the 10-year, they don't move directly with each other, but the best way of looking at it is the 10-year is the owner walking his dog on a leash, and mortgage rates are that dog on a leash. Can they get a little ways away from the master? They sure can, but they can't go that far. So that's about a 0.75% change in interest rates in the matter of 1 week from low to high. Now, we probably never saw those actual lows on a rate sheet. The highs we absolutely do, because the thing that is really important to remember, and let's maybe tell a little story here. I have a borrower who is in escrow right now. Rates have improved about 0.1% since he's been in escrow, and we've got about 3 more weeks before the scheduled closing. So I asked her, I said, hey, we've seen some improvement, still a lot of volatility. I don't have a strong feeling. Do rates get better or do they get worse from here? And we've got a lot of news coming out this week that could move it. So do you want to lock or do you want to wait and see if it improves? He goes, I really want 6.625. Let's float. So, okay, well, let's put that into context. A 0.25% movement is truly just about a 0.25% in the 10-year, but that's 100 basis points of movement in mortgage-backed securities. And for us to see 100 basis points, that usually is not a 1 or 2 week move. You get these violent periods. We've seen 100 basis points in a day, but that's not the norm. A normal intraday range is maybe 10 to 25 basis points movement. So if you got 25 basis points, which is a pretty big day-to-day move, and you got them in your favor 4 straight days in a row, is what it would take to get all the way down there. So I don't have a crystal ball. I don't know. And I certainly can't tell that borrower that you're wrong. This isn't going to happen. But we put it into context. That's what has to happen for it to improve. And are you okay floating it? And in his decision, he's like, yeah, I think rates are going to go better. I think the data is going to come out in our favor. I think the economy is slowing. Now, big picture
I've been
right
thinking
now,
that for like a year and a
we've
half.
been
Josh.
thinking it for like 2 years. But the uncertainty and the volatility right now makes it really hard to say, regardless of what I think is going to happen in the short run. So like if we were looking here at a chart of the 10-year, really going back to the middle of February, we've been in a very narrow range, but we've had a spike down below for 3 or 4 days and a spike out the top for 3 or 4 days. So you get these weird aberrations from day to day when we have a volatile, uncertain market like right now. So from that perspective, that's what you need to know, that if we're looking at the trend, if we're looking at the chart, it looks like rates are going to continue to get better. That doesn't mean it's guaranteed, and it will fall back on the fundamentals. And that is, when Fannie Mae looks at it and says, hey, we're going to drop our forecast 0.1% to 6.2 for the end of 2025, 6.0 for the end of 2026. Why would they do that? They're looking at the underlying fundamentals, that they think the job market is going to weaken. They think that the economy is going to weaken. So this morning, we got GDP figures, the first look at Q1 GDP, and they were negative. But there's a giant but there. Jeb, what is the but? There was a massive increase in imports in the first quarter because companies were importing a bunch of stuff ahead of the tariffs. And the way that works through those numbers is it makes it look very negative. A lot of consumers bought a lot of autos in the first quarter. So weird aberrations because the tariffs were signaled ahead of time. People knew they were coming and it changed behavior. So that's what we're saying. It's going to be another 90 to 100 days before we get a look at Q2. And Q2 is going to be where the rubber hits the road. And truthfully, we won't know until Q3 how this all shakes out. But right now, it's looking like the economy is slowing. Does that mean a recession or just slow growth? We don't know, but definitely slowing, which generally is disinflationary. It doesn't mean deflationary. It doesn't mean prices drop, but it means inflation recedes. What we've seen, it's been slow and it's been in fits and starts with little head fakes either way. But over the last year, inflation has been improving. We've got a 2 handle, depending on whether you use headline or core, PCE or CPI. All of them have a 2 handle on them right now. They're not 2.0 on the core PCE like the Fed would like, but they're progressing in that direction. Rents continue to underperform relative to how they're measured in CPI and PCE, which should tell us there should be some continued downward pressure. We saw JOLTS. The job opening and labor turnover survey came out yesterday, and it shows that there were like 600,000 or 700,000 less job openings than were expected. And to kind of put it in context, when the Fed looks at this, at the worst levels during COVID, there were 2 jobs available for every 1 person unemployed looking for jobs. We are now down to 1 to 1. So there's half as many jobs available for the people that are looking. So if it's like anything else, if you're dating, you're looking for a job, you want options. So you went from having 2 options to having 1 option, which means that wage pressure is not there anywhere near to the degree that it was. So those are the things that we're looking at macro, big picture, that once these tariffs do clarify, where do they settle out? How many deals are set? What does the new normal with China look like? There's still this expectation that there's going to be underlying weakness and rates will improve. We're not talking about 2-3% interest rates. We're not even talking about 4% interest rates, but per Fannie, 6.0 by the end of 2026.
Well, I think what's really important to kind of focus on out of what you just said is that all of that takes time to work its way through the market. Whether you believe it's going to have a positive impact on the market, whether you think it's going to have a negative impact on the market, it's not immediate, right? What's immediate is the tweet, the comment, the headline that's on, mainstream media. That's what gets the immediate reaction. But the reality is you're not going to see it in the underlying data for weeks, months in some cases, and you're going to need months of either positive or weaker economic data, whichever direction you're going, to actually get a trend there. And that trend is going to dictate what the future holds. So with mixed economic signals and, kind of starting the show talking about how, rates are more reactive to positive economic data than they are to weaker economic data, is because the consensus is that all of this is going to impact the economy in a negative way by adding inflation, and that's going to put more pressure on the Fed to keep rates higher, so on and so forth. So I think if I were in the market, and we're going to talk about how it's impacting housing and what you should do, but you have to understand that if you're in the market right now, what you're seeing is, I think, kind of what's going to be there. Unless you're 6-8 months out from here, I don't know that there's a huge change in pricing. Yeah, 0.25% here or there, but are we going to see 6.25% by the end of 2025, Josh? Possibly. But is it going to stay at 6.25%? Is it just going to hit 6.25% once? Is it going to come up? So I think that's, when they say 6.25%, Josh, what are they talking about? Is that the average, or is that just we're going to hit it at one point?
Well, if you look, our preferred measure for you following along at home, trying to find real numbers, not some liar rate chart at bank rate, a real number, look at Mortgage News Daily and go look at their chart over the last 2 years. So they're saying, and this is not a fault of Fannie Mae, any economist, they're going to ask for a projection and a timeline. And we're saying at this point in time, it's going to be exactly here. But you just made a really important point. There for a day, there for weeks, there for months. We haven't seen a level stuck and hit consistently for the last 2.5 years. It's been volatile, up, down, up, down, up, down. So that lock float decision has been very important and also very difficult over the last 2 years. What I can say is when we're talking here in the context of should this impact your buying decision, the buyers that I have right now, the 6, 7, 8 people that are going to close on a purchase this month, none of them are the type of buyer that it's a make or break decision. Hey, you pre-approved me at 6.625 and oh my God, rates shot up at 6.875. I don't qualify and I'm no longer comfortable with that payment. Almost all these people are fairly well qualified. And like the borrower we talked about earlier, he says, I want to see it at 6.625. If it goes back to 6.99, I'm fine and I'm okay taking that risk. So those are the type of people that are in the market. So for the most part, if that's you, this really shouldn't be changing your decision. If you've decided this is the right time in your life, homes in your area are what you want and you want to become an owner, or if you're selling and moving up, moving down, relocating, any of that, I don't know that this really changes your decision. I think we're going to see Q2 and Q3 are going to be sideways with a drift lower. So when we say a drift lower, maybe it's 0.25% over 60, 90, 120 days. Is that worth waiting for? It's not guaranteed. I don't have a crystal ball. I can't tell you it's coming. And it could just as easily go the other direction. So from that perspective, I don't know that this is a game changer on any front. Other than let's maybe shift and talk here, Jeb. In that same Fannie Mae forecast, they forecast everything. They forecast unemployment. They forecast GDP. They forecast all sorts of things. So they are projecting home price appreciation for the calendar year of 2025 of 4.1, downshifting to 2% in 2026. Well, last week's episode, we talked about interest rates in the context of what it does to home prices. This is where this comes into play, because we have seen when rates approach or drop beneath 6.5%, mortgage applications jump. Do they jump to like crazy frenzied levels? No, they don't. But that is where I see an increase in activity and sort of a floor under prices. So even in areas where the inventory is kind of spiking relative to where we were pre-COVID, during COVID, that will put a floor under it and it will keep things positive in most parts. And to the flip side, if we see that at 6.5, once it goes above 7%, again, we only see the most well-qualified, most committed home buyers staying in the market. So we've been, for the most part of this year, Jeb, 6.5 at the best, 7% at the worst for well-qualified borrowers. And it's kind of kept us in this little stasis here. And we're seeing a decrease in the momentum of home prices. But what do you see relative to what Fannie Mae's expectations are and how interest rates play into that?
Well, what we've seen is inventory's grown now 31% higher than last year, the most inventory we've seen since 2020 on the market, active inventory. And then at the same time, almost 36% of the homes on the market have had some sort of price decrease, which is the highest that we've seen in 10 years, the last 10 years. So that tells me that rates are having a bigger impact on the market in two ways, right? Homes, there's sellers wanting to come to the market for one reason or another, right? And whether they're in a low fixed interest rate and just tired of waiting, or there's some sort of life event that happened and they need to sell a property. These properties are coming on the market, but the problem is the demand is not there to take them off. Right? We always have listings come to the market, but typically it's met with buyer demand, and therefore the inventory numbers haven't grown the last couple of years because of the frenzy out there in the market. And so, and that's not to say that some of these sellers aren't also buyers. So they sell a house, they buy a house. So there is that you're factoring in. But the reality is it's having a negative impact on the listing side, positive impact for buyers because there's more options. You know, it's easier to get your offer accepted. There's less competition. You're now negotiating a little bit stronger. But what does that mean? It's relative, Josh. It's, we can sit here and play the game of I'm just going to wait until prices go even lower. Okay, that's fine. It just, I don't know that that's the metric that I would be using personally to gauge whether or not I'm ready to buy a house. For me, it's finding the right property at a price that I'm comfortable with, at a payment that I'm comfortable with, knowing that that's where I'm going to be for the next 5+ years. And if that makes sense to me, and everything else checks off, then it is what it is, right? I'm not sitting here thinking something. I've never bought a house based on, where I thought the market was. I've done really well in the market. Sometimes I've bought at the top in the market, and it's just one of those things. So, Josh, if you're a buyer out there, like, what does this mean? Like, what does it like? What should you be thinking about? Outside of what I said.
Well, we've looked at this. At the beginning of the spike in interest rates, when home prices, we had seen the 2020, 2021 big run-ups. Bill McBride did an awesome breakdown of what he projects, and he thinks 7-8 years of relatively flat prices. And we pretty much agreed with that. Well, the first 2 years, 2022, 2023, 2024, the first 2.5 years of this new higher interest rate regime, we saw higher appreciation than what you or I expected with those higher interest rates. So, cumulatively, probably up 10% over that 2.5 years, which is a pretty high number when you have a spike in prices and a doubling of interest rates. So going forward for me, because of the lack of supply, I don't see any massive change, but the interest rates will dictate what happens here. If we stay in this 6.5 to 7% range, then we're kind of right here, flat to slightly positive year-over-year appreciation, very low volume, and under 6.5, then you're going to see more appreciation. Are we talking 7, 8, 10%? No, but maybe 3, 4, 5% appreciation, more activity, and the lower you go, then the more room there is for appreciation and the more room there is for activity. But I think we're sub 5% appreciation nationwide, any way you cut it, unless magically rates are at 4.5%, in 3 or 4 months, which neither of us really see a path to. So the flip side is if you're looking, there are regional differences. If you have a regional economy that has a problem, condos in Southwest Florida, there's issues there. So absent something like that, when we're talking most markets in the country, the flip side would be if we get above 7% and stay there, not for 2-3 weeks, but for 4, 5, 6 months, you absolutely, even on a national basis, could see a decrease in prices. But does that mean prices are crashing? They're down 10, 15, 20%? Other than those markets that have other underlying issues, there's not, because what happens, and we've talked about this repeatedly, especially in a market where homeowners are sitting on record levels of equity with record low interest rates, They just sit, they just post up. So, that person who doesn't like the idea of moving and giving up their 2% interest rate, if the property drops 3, 4, 5%, it's probably going to say, hey, you know what, we got the golden handcuffs on. We're locked in here for a while. So that to me really is the story. And I know people don't like hearing this, but interest rates are going to dictate the trajectory of the housing market, both in terms of appreciation and sales volume. The lower they go, the more positive appreciation is and the more sales volume you get. And the higher they go, could even push sales volume a little bit lower from where we are right now. And you could see negative year over year pricing, but that would require rates above 7% for a consistent period of time.
And I'm going to say something that's going to shock people. You shouldn't be relying on Josh or myself or the media to tell you when to buy a home. It should be buying when it's the right time in your life. Financial stability, job stability, relationship stability, money in the bank, comfortable with the payment, longer term time horizon, and making the decision based off that, right? If you can look 5 to 7 years from now, 10 years from now, and look back, I promise you, you're not going to have regrets with buying. It's the way that it works. So if I were in the process right now, I'd be working on getting pre-approved, even if I'm not buying for 6 months, 8 months, a year. Go through the process now. Maybe you need to work on credit. Maybe you need to save a little bit more money down. Maybe you just need to see what the numbers look like so that you can get accustomed to that. Maybe you start making that housing payment now and, you're making your rent payment, you're putting the additional in an account so that you're just comfortable every month getting used to a higher number, because the earlier you buy a house, the earlier you fix your housing cost, the better off you're going to be long-term. You're going to make more money. It's going to become less of your budget. Again, it's one of those things that favors those who actually take action. So if Josh and I can be of assistance to you, we can guide you through that process. There's a link in the description of the video. But until next time, make sure you're buying right, borrowing smart, building wealth. Adios.
Amigos.